Hello, everybody, and welcome to our discussion on the Seoul Community Hospital and Medicare Dependent Hospital volume decrease adjustment. So in this video, we're going to be giving an overview of this volume decrease adjustment, what it's for, how to apply for it, and we're going to talk about the regulatory requirements as well as the policy requirements. And then at the very end, we're going to be discussing how we as a MAC review these volume decrease adjustment requests, and therefore what we would be looking for a submission. So as an overview, for facilities that are eligible for Seoul Community Hospital or Medicare Dependent Hospital status, generally by the nature of that, it's a protected status, and they're reimbursed in a different way, in a separate way, to help prevent against cost increases that don't actually get covered by the federal payments, the DRGs, the DISH, the IME, all of that. So there's an additional payment available just from the operating side of things. That's the hospital-specific payment. So there's a natural protected status for these facilities. So that special payment, that hospital-specific payment, is based on the discharges and more specifically the DRGs, the DRG weights that take place throughout that period. So the federal payments themselves are, of course, based on that DRG weight multiplied by a federal rate. The hospital-specific payment, it's the same DRG weight, but it's multiplied by a cost-based hospital-specific rate from a base year, inflated forward. So that's the special treatment there. The idea is to try to help prevent against excessive costs that's not covered by the federal payments. So that covers your normal scenario throughout the normal years. There's also something referred to as the volume decrease adjustment, which is the main topic of this video. And this is not intended to be an ongoing type payment like the hospital-specific payment is. Instead, this is to prevent situations where all of a sudden a volume decrease takes place, so the discharges, the DRGs decline significantly, and as a result, all of those DRG related payments decrease as well. Now the problem with this, even though they're being reimbursed on kind of a quasi-cost basis due to that hospital-specific payment, there's still a concern that that cost payment is not going to be sufficient to handle the decreased discharges. Because keep in mind, as the discharges decrease, your hospital-specific payment is going to decrease as well. So the problem is with certain types of costs. Variable costs, by their nature, will decrease as the activity decreases. So if there are fewer discharges, then there should also be fewer of these variable costs, so there's no concern with recovering those. However, fixed costs, at least in the short run, do not decrease, certainly not as quickly. So what happens here is you have these DRG related payments. Even if it's a hospital specific payment, they're still DRG related, discharge related if you will, and they may be insufficient to cover these fixed costs in the short run. So this volume decrease adjustment is intended to help cover some of this. That's the underlying intent for it. Now, the other question about this is that not all costs fall under a nice, easy variable or fixed category. So the question is, how do we handle the semi-fixed or semi-variable, also referred to as mixed costs? And that basically means it's part variable, part fixed. Think of utilities where you have a base rate for the month, and you also have a variable rate based on how much of the activity you use, how many of the kilowatts you use. So that's what we have here, just to set the stage for this. One other thing I wanted to mention before we continue on is that there are two payments that have the word volume in them, and quite often they're incorrectly used as interchangeable. They're completely separate things, although there's a lot of overlap between the providers that receive them. Low volume, at least up to this year, is fairly common. That may very well switch depending on the final rule, the final IPPS rule. That may very well switch next year, but the volume decrease payment historically has been quite rare. And we'll talk about why. We'll talk about all the requirements for that. So again, the volume decrease adjustment is very rare. Quite a few stringent requirements to meet. The basic goal of this video is to make sure providers are aware of whether they may or may not qualify for this payment, and if they do believe they qualify and they do plan on submitting a request, to make sure you're aware of what you need to submit to get that and how to calculate the payment. So a lot of stringent requirements there. Now the sources we're going to look at are two different regulations, although they're extremely similar. One is for the SCH specifically, the sole community hospital. The other is for the MDH, Medicare Dependent Hospital. Again, the verbiage is virtually the same. The underlying requirements are the same. And then we get a little bit more detail in the CMS policy manual at Pub 15.1, Section 2810.1. So we'll talk about all three of those. So let's get into the regulation first. Now, I've only copied the SCH verbiage, but again, it is basically the same, so we're just going to leave it at that. So for cost report periods beginning on or after 10/1 of 83, that's when the IPPS began, so that's when this payment began as well. The MAC provides for a payment adjustment for a sole community hospital for a period during which the hospital experiences, due to circumstances beyond its control, that's what this paragraph E2 talks about. We'll talk about that later. A more than 5% decrease in its total discharge of inpatients compared to its immediately preceding cost reporting period. The one thing I want to mention here right away is this verbiage, more than 5%. That means that you can't round. It has to be more than 5%. So 5.001 would work. 4.99999 would not work. More than 5%. So it exceeds 5%. 5.00000 would not work either. So if either the cost reporting period in question or the prior cost reporting period is not a 12-month cost report, then you must basically convert it to a monthly figure and multiply by 12. In other words, annualize it. So we need both of the periods to be an annual period for comparison. So that's the overview of what we're talking about. To qualify for this payment, assuming you've met the more than 5% decrease, you must submit the request no later than 180 days after the date on the NPR. Now, this is no later than. It doesn't really provide an earliest date. Technically, you could send one in mid-year before the cost reporting period, before you file the cost report, before it's been settled. I guess the cost reporting period has to be completed for you to have this data, this 12-month data, but it can be submitted before the final settlement for sure. Generally, this will be held until the NPR, though, at that point. But it has to be no later than 180 days. We cannot do this through a reopening that's 2 years later, 3 years later, anything like that. It has to be within what's basically the appeals period, the 180 days. So we're going to be looking for certain information based on this regulation. We need the information about the size of the decrease in discharges and the resulting effect on the per discharge cost. We'll talk about that piece. Number 2, out of the regulation, show that the decrease is due to circumstances beyond the hospital's control. We'll provide a few examples of that as well. Now, there were some changes on 10/1/2017. So this talks about cost reporting periods prior to that. It basically gives the actual calculation for it. We're going to focus more on the requirements after 10/1/2017 because obviously that's what the majority of the requests will be for at this point in time. So if we jump down to the middle of this paragraph, we have the on or after 10/1/17. The MAC determines a lump sum adjustment amount equal to the difference between the hospital's fixed Medicare inpatient operating costs and the hospital's total MSDRG revenue. In other words, the federal, hospital specific, all of that, including outliers and also including the DISH, IME, and there's also the low volume payment if they get it. That becomes part of the operating. So basically, we're looking at all the federal payments you're getting for inpatient operating costs, comparing it to the fixed portion of the inpatient operating costs, the allowable fixed portion. We'll talk about that later. And we're taking a look at that and multiplying it by the ratio of fixed costs to total costs. So the regulation continues. In determining this adjustment amount, the MAC considers the hospital's needs and circumstances, including a review of the core staff, any minimum staffing requirements. It brings in the review of the hospital's fixed and semi-fixed costs. And again, we'll focus a little bit more on semi-fixed in just a bit. We'll talk about the length of time the hospital has experienced a decrease in utilization. This basically relates back to the fixed costs. If this decrease has been continuing steadily for a long time, first of all, you may not hit the 5%, which means you wouldn't qualify to begin with. But if it's an expected decrease, there's an expectation that the hospital would have taken steps to reduce these fixed costs. And the idea behind that is that fixed costs in the short run are not necessarily controllable, but in the longer run, they are controllable. At some point, it's reasonable for a hospital to take steps to reduce those fixed costs. Now, the MAC, once we get the information, we have 180 days to review the request. And, of course, this is an appealable item. It's subject to review under the appeal regulations. So that's the regulation summary, and this is just a kind of a bullet-pointed list of those items. Now we'll spend a little bit of time with the Pub 15.1 Section 2810.1. I will stress that this was updated in 2018, just shortly after those Federal Register and regulation changes. And it was very good that it was updated because it had not been updated since really the beginning. For a long time, it didn't even include MDHs, even though they were in the regulation. There was an end date in this manual, and it's been removed since this is open-ended. And the big thing is the examples and cost report line numbers have been updated. Now I'm just very briefly going to open up the policy manual. It's pretty lengthy, so we're not going to go into great detail on it. I'm going to talk about that throughout the slides. But 2810.1, there's a lot of similarity between the regulations and this, but of course the policy expands on it quite a bit. So it talks about the criteria. And again, it goes through the detail about the circumstances beyond the hospital's control. You can see strikes, floods, inability to recruit essential physician staff, prolonged severe weather conditions, serious and prolonged economic recessions that might impact admissions, COVID, the COVID pandemic, the public health emergency, certainly that would have a direct impact on admissions. Certainly it's not partly an economic issue, but also a health issue there. And similar occurrences. That's where COVID would probably fall into. So we have to take into consideration how frequently a sole community or MDH hospital requests this adjustment. And really, as I said earlier, whether or not the sole community hospital took reasonable steps to mitigate the cause of discharges. So were they truly beyond your control? Did you have successful or sufficient recruiting efforts to replace a physician, efforts to cut costs where possible, etc.? So this number one is certainly a subjective criterion, but it's one we do have to look at. And then we take a look at the decrease in discharges. Again, I want to stress it's more than 5%. And here this just gives some examples with dates. You can go through those if you'd like. The amount of the payment adjustment. So again, if we go down, it talks about the fixed versus variable cost. It gives you a little bit more of a definition of some of those, as well as the semi-fixed costs. Talks about when this must be requested. We covered that. Here's an example of discharge data. So when we are reviewing it, that's basically what this is getting at. When you request this payment, we need, of course, the general information about the hospital. We need detail about the discharge data from the two cost reporting periods. We need a narrative of the circumstances. And what we're going to spend a little bit of time on toward the end is looking at this cost data. We actually have a template that we've created that will help you to document that for us. But basically, you're going to take a look at the cost centers on Worksheet A, all of the total costs you've reported, And we need to know which of those are variable, which of those are fixed, and if they're semi-fixed, we need some more information on what steps you've taken to try to reduce those. So that's what's going to happen here. Now, there was a core staffing review that was required. This was for cost reporting periods prior to 10/1/17. So there was a requirement that we'd review the staffing compared to any minimal levels that the state requires. That obviously was taken away October 1st, 2017. And most of our reviews are going to be after that, so we're not going to focus too much on that. If for some reason you're in the middle of an older review or even an appeal, then you'd want to refer to this verbiage. And here's the verbiage for beginning on or after 10/1/17. Hospitals are no longer required to demonstrate that they've adjusted the number of staff due to for that excess staffing. And it doesn't have to be considered in the payment calculation. This talks about that interim VDA determination. Again, there's nothing really requiring you to wait until the NPR. However, if we don't have enough information, if it requires an audit to review the cost, we may need to wait for the NPR anyways. You can submit it prior to the NPR, but we may be waiting for the NPR anyways. And if we go down further, there's some more examples there. And you'll see the cost reporting periods beginning on or after 10/1/17. So again, the point here is we're taking a look at the difference between the actual costs you have and what the payment is for those costs. The federal payment for those costs, federal and hospital specific, I should say, since it's a sole community or MDH hospital. So we'll take a look at the program inpatient operating costs, the fixed costs, and any allowable semi-fixed as well. We allow that portion of it. And the fixed cost portion of the total payment for those inpatient operating costs, which would be, again, the low volume adjustment. That would be included. The outliers would be included, all of that. So the idea is we're comparing apples to apples there. So this calculation is new for the 10/1/17 and after. We'll take a look at step one. First of all, we have to determine a fixed cost ratio. So we take the inpatient fixed and semi-fixed costs that were determined to be allowable, divided by the total inpatient operating costs for that period. And then we take that fixed cost ratio and multiply it by the program inpatient operating costs, which we'll see from worksheet D-1. We'll see that in just a little bit. This gives us the fixed portion of the program inpatient operating costs. And keep in mind, this number one is total. Number two is program specific, Medicare only. So that's the point. We're trying to get a fixed cost ratio based on your total costs, and then that fixed cost ratio is going to be used for both steps 2 and 3 to determine how much of the Medicare costs that have already been determined through the cost apportionment on the cost report, what percentage of those or how much of them are related to fixed cost. Step 3, we're using that same fixed cost ratio to determine how much of the overall payment, the Medicare payment, was related to that fixed cost portion. And then step 4, we're just subtracting steps 2 and 3. So did that fixed cost portion of the payment cover the fixed cost portion of the cost or not? Here we have some examples. We're going to see a worksheet that goes through that in just a bit as well. And that's what we have for the policy. This section H just basically adds in the discussion that an MDH can qualify as well. So now we'll continue back through the PowerPoint. So the first piece of this is your initial request. What information do you need to submit? I mentioned this before. It has to have general information about the provider, the hospital's name, address, provider number, and the date of SCH classification or MDH classification if that's the case, because that determines whether you even qualify to begin with. You must be a sole community or Medicare Dependent Hospital. We need the discharge data from both the current and prior year. We need a narrative of the circumstances surrounding this decrease and how they were beyond your control. We'll need information from the cost information from both the current and prior cost reports, along with an analysis demonstrating that those total program inpatient costs do indeed exceed the DRGs plus the outlier payments. And then we're going to take a look at those semi-fixed costs specifically to see the narrative on what actions were taken as an attempt to reduce those semi-fixed costs. We'll need to see that narrative. And these last two items were only pre-2017, so they're no longer required, that comparison of the employees and salaries. So let's go into the review steps that we're going to be taking. And what I'm going to do after we go through these steps, I'm going to show you a little bit of the work paper we use. Basically, it's just showing these same things, but I just wanted to point out that we are required to review for these items. So, proof of 5% decrease in discharges. So, again, the regulation requires that we annualize either period that might be short or long, for that matter. If it's not a standard 12-month period, no rounding is allowed, but keep in mind this has to be more than 5%. So it could be 5.0001, but it can't be 5.0 exactly, and it certainly can't be 4.999. It has to be more than 5%. And we're going to take a look at the trend of discharges, as I said, to see whether it's a one-time change or is it an ongoing trend that perhaps should have been under the provider's control to some extent. Number two, of course, continuing on that, is there justification for why the decrease is beyond the provider's control? These are just examples that were given in the manual. Again, COVID is likely to be used in some cases. Number three is essentially a threshold before we continue further review. The question is, do the federal payments already exceed the costs before any sort of downward adjustment to remove out the variable costs and all of that? The idea is that if the federal payments already exceed those costs, and we know that we're going to be adjusting the costs downward, then there's no use going further if the federal payments already exceed the costs. So the payment is only going to bump the provider up to that cost amount. Remember, we're comparing fixed portion of the payments to fixed portion of the cost, but nonetheless, you're only going to get that cost amount recovered. So if those DRGs and other federal payments already exceed those costs, there's no use going through the rest of this calculation. Now, when we talk about the costs in question, we're talking about the total program inpatient operating cost, excluding any pass-through costs, because those are already separately reimbursed. That's the idea of pass-through. They're not paid by these federal payments, the DRGs. They're paid on a cost basis. Now, this is Worksheet D-1, Part 2, line 53. So those costs must exceed the total Medicare payment, which is on E-Part A, line 49, plus any low-volume hospital payment adjustment. Keep in mind that line 49 would have already included the DRGs, the outliers, DISH, IME, all of that. Now, for the core staffing, again, assuming you're dealing with a cost reporting period beginning on or after 10/1/17, this core staffing is no longer required. But number 5 is required. It's a cost center breakdown to ensure that the variable costs are removed, because those should have been reduced when the activity reduced, as well as any semi-fixed costs where there were insufficient attempts made to reduce the costs. Again, somewhat of a subjective review, but we need the narrative explanation for what attempts were made. Now, as far as payment calculation, what we're going to be doing here, we're going to compare the current year operating costs themselves, D-1 Part 2, line 53, and we're multiplying that again by the fixed cost percentage, which we're going to see in just a bit. So we only want the fixed cost portion of it. This example's just a random one. I was just entering some numbers, but on the next tab it ended up being 97% fixed cost. That's extremely high, very unusual, pretty much impossible at this point. But let's say it was 97%. If I had an amount in here then we would be comparing 97% of that to 97% of the payments, the Medicare payments being made. So line 49, again, that's everything. That's the outliers, the DRGs, the DISH, IME, all of that. Plus we have our two lines for the low volume adjustment. Again, the fixed portion, it's going to be multiplied by that same percentage as above to get an apples to apples comparison. And the volume decrease adjustment limit is again going to be the difference between those two. If the costs were $100,000, the payment for those costs was only $75,000, then you'd have a $25,000 volume decrease adjustment. Now the form we're going to be looking at walks you through the things we're reviewing, and it walks you through the actual calculation of that fixed cost percentage. If you want to request a copy of this calculation form, you can send an email to me at audit.advisement@wpsic.com. Of course, you can use your own documentation as well. This form I'm walking through is just the one that we will use to recreate that calculation. So now I wanted to walk through that. So the first thing I'll focus in on is the variable fixed cost analysis tab of this. There are some instructions here, but basically what this is saying is we've essentially recreated some of worksheet A. So all the different cost centers that you might have need to be added in here. The number, the name, and then the total cost on column 7. We're not so concerned about was it reclassed, was it adjusted, any of that. We're concerned with the total cost here. So this is the example I had from earlier. I just typed in $10,000 for a particular cost center. Now, the blue is a calculated number, so you don't need to overwrite that. What you would do is enter the portion of this $10,000 that is variable. Again, these are just very random numbers. I just typed it in to show a calculation. Let's just say $100 of this $10,000 was variable. And you would also, that gets subtracted, you would also include the portion of this $10,000 cost that was semi-fixed and you did not have sufficient documentation to show that you've taken actions to reduce it. So these are the semi-fixed costs that might be excluded. So if you've taken all the actions you can and you can describe it, then this would be 0. And the only thing that would be carved out is this variable. The other semi-fixed costs would have been left over. They'd be allowed. So this column is only used if you have some costs that you just have to exclude because you didn't take any actions to reduce them. You would do that for all the different cost centers. It's broken down by each section. And then at the very end, you would also want to, so anything you had that had this excluded semi-fixed cost, so in this case this $200, any of these you would also need to include down here in this row 166. Anything that has an amount in column F above, which was the excluded semi-fixed costs, need to be included here with these corresponding amounts brought in so that it can calculate how much overhead should also be stepped down to that fixed cost, because that would not be considered allowable either. The semi-fixed cost would be excluded as well as any related overhead. So this is basically handling an approximation of a step down for this, just carving that cost out as well. And then it gets carved out right down here at the very end. So if I did have some, it would be carved out here. And in the end, your percentage down here, since I didn't have any of these excluded units, let's just say we didn't have any overhead for that, then I end up with 97% because 9,700 of my 10,000 was allowable. So that's 97%. Now that percentage again is going to be used. This is the screenshot I showed you earlier. It's going to carry over to this tab, and it's going to be multiplied by both the inpatient operating costs as well as the Medicare payments. So that's the idea here. These are both Medicare, by the way. Calculating the 97% took total costs. Worksheet A, column 7, that's not just Medicare, that's every payer type. But over here, the actual calculation, both of these are Medicare only at this point. So that's what we have here. And just to show you what we're going to review, we've already talked about a lot of these things. I've shown some screenshots. We're going to review for what's in the submission package, the request package. If we don't have all this information, we can't continue with our review. It would have to be denied at that point. Is there a 5% decrease in discharge? And this is actually greater than 5% decrease, remember. We'd also look at a trend analysis to see, has this been going on for 3 years? And were there any attempts made to control this? Number 3, what was the narrative for whether these circumstances were beyond the provider's control? Number 4, that's that little threshold step before we even continue. We want to see, were the federal payments already sufficient to handle the total cost? Because if it is, then there's no use continuing forward, because the costs would just be reduced once we determine the fixed cost portion. This is bringing in the low volume payment. It's adding that in as well. It's bringing it up to this calculation. Number 5, the variable fixed cost analysis. Have you already removed variable costs from your payment request, or have you identified them but not removed them? In that case, we'll go through that cost analysis to do that. And number 6, did you take a look at the semi-fixed cost, and did you make attempts to try to reduce those costs? Depending on how much time there was, if it was a sudden event, then certainly there wouldn't be much time to reduce them. But if it's been a trend, then we would expect some reduction, or at least attempts to reduce it. Number 7, if this cost has not been finalized, if this cost report has not been finalized and we're looking at it in the interim, should it be referred to audit? Do we need to review that in more detail? So again, that's if the auditor sees unusual factors with the cost, unusual differences from year to year, or any other reason. And then we end up with the volume decrease adjustment calculation, as we said earlier. So this is the work paper that our internal auditors use for this, and hopefully it will help you to, if you do believe you qualify for this, hopefully it'll help you to submit the proper documentation for this review. The only other thing I wanted to mention is that if you would like a copy of that form, please send me an email and I could respond with that copy so you can send that in. So thank you for your time today. I hope this has helped. Have a great day.